earlier this morning, NYSE parent company Intercontinental Exchange released the latest edition of the Mortgage Monitor. It revealed that lower mortgage rates put nearly 5 million borrowers, quote, in the money, end quote, for a refinance. Joining me now is Andy Walden, head of mortgage and housing market research for Intercontinental Exchange. Andy, welcome.
Good morning, Ashley. How are you?
Doing well. Welcome back. So we understand that declining mortgage rates unlock refinance opportunities for most people since early 2022. What does this reveal about the market's sensitivity to rate shifts, Andy?
Yeah, it's really a reflection of where borrowers have been buying homes from an interest rate perspective over the last couple of years, along with where rates have been fluctuating over the last few days as well. The most popular interest rate bands that we've seen from an interest rate perspective over the last 3 years out there in the market have really been in that high 6 to 7% range. And then you look at where mortgage rates have been over the last really 2 months out there in the market. They've been in that low 6% range. So these folks have been teetering kind of on the inside outside of that refinance incentive. I think we all know that the administration directed the GSEs to buy $200 billion in mortgage-backed securities earlier this year, which has compressed the spreads between 10-year yields and mortgage interest rate offerings out there in the market. It's really moved some of these borrowers over the hump into that refinance incentive. So really kind of a reflection of not only where interest rates sit right now in terms of outstanding homeowners, but also where rates have been fluctuating over the last few weeks.
And generally speaking, how much or little do rates need to slide for refinancing activity to pick up?
Yeah, it really wouldn't take a whole lot more. Again, if you look at 10-year yields and where they're at right now, they're in the 4.25 range, and spreads between yields and mortgage rates have been in the 185 to 190 range. And so really all we need is for 10 years to go back down to where they were in that October, November timeframe last year. And that would be enough to pull mortgage rates down into the high fives, which is a number that we haven't seen for more than 3 years out there in the market, and kind of surpasses that psychological threshold that would move some of those homeowners to act as well. So really not a whole lot of movement would be needed in 10 years to get us into that 5 handle from a mortgage rate perspective.
All right. And Andy, according to your report, the monthly principal and interest payment needed to purchase a home fell by $164 on average. Based on that data, how is this affordability stacking up historically?
Yeah, when we look at home affordability out there in the market, home affordability, obviously we're quickly creeping up on the spring home buying season this year. Home affordability, when you compare it to the last few years, is the best that it's been, dating all the way back to 2022. So certainly some improvement in the home affordability dynamics out there in the market. Certainly going to be a continued topic of conversation this year as well. When we look at it from a regional basis, Midwestern regions of the country, 12 of those major markets are now back to long-run averages. Areas like Chicago, Detroit, Memphis is back to long-run averages as well. On the other side of the spectrum, though, when you get into coastal and more expensive markets, California, New York, Miami, certainly still stretched from a home affordability standpoint. We're a number of years until we get back to long-run averages in those areas of the country. But certainly some green shoots here as we enter 2026 from an affordability perspective.
All right, and the Mortgage Monitor also shows that home price growth slowed to its weakest in a calendar year since 2011. But we understand that this varies across U.S. regions. Can you elaborate?
Yeah, when we look at home prices across the country, certainly some geographic variation from a home price perspective as well. You can kind of draw a diagonal line from kind of Washington down to Florida. When you get northeast of that diagonal line, home price is still largely moving in a positive direction, anywhere from 2, 3, 4% home price growth all the way up to 6% home price growth. When you get into areas of Connecticut, in New York, those are areas that are still largely supply constricted from where we've been over the last couple of years. When you get south and west of that, really centered around Florida, Texas, California, those are areas where you're still seeing home prices down from the same time last year. Gulf Coast of Florida still meaningfully below last year's level. Austin and San Antonio, Texas. And then again, you get into those California markets and largely kind of modest declines in home price growth. So we're still seeing those geographic divides that really define 2025 as we enter the spring home buying season of 2026.
All right, and do you foresee 2026 being a buyer's or a seller's market?
Yeah, nationally, it's still what I would call a neutral or a necessity market. Nationally, it's birth, deaths, divorces, those life events that drive folks to make home purchase activity out there across the country. But again, when you look across the country, it's that diagonal divide that's really dictating whether it's a seller's or buyer's market out there. Sellers still largely control the Midwest and Northeastern regions of the country where there's not a whole lot of supply. In the South and West, where you've seen supply levels start to pick up and even move into surplus territory at points in time last year. Certainly, buyers have more negotiating power than they have over the last couple of years. Maybe some more concessions to be found in those South and Western markets early this spring.
All right. And what housing market trends do you expect will come more into focus as we approach the spring?
Yeah, affordability is always a key topic of conversation. That'll continue to be the case early this year. You're not going to stop hearing the word home affordability and stop seeing those measurements pop up here throughout the 2026 home buying season. What's really going to move the needle, though, from a housing market perspective this year is the supply side of the house, right? It's what's driving those geographic differentiations that we're seeing right now. Again, the Northeast still 30, 40, 50, 60% short on supply in some of those areas of the country. That's what's driving those firmer home prices. In the South, is that ballooning supply that we saw last year and then a little deflation at the end of last year. So the supply side dynamics are really going to be what we're watching closely this year to kind of tell us where home prices are going next.
All right. Thank you, Andy Walden, head of mortgage and housing market research for Intercontinental Exchange.
All right. Thank you, Ashley.